great investing is more about the temperament of someone rather than the knowledge, IQ, or tactics, strategies. They're important too, but above all of that is probably temperament, because classic example is that you get we spoke about earlier with a property that you're thinking about selling, and you can see that capital growth isn't great. That's more of a temperament question, because that's more about, can you overcome some cognitive biases within yourself to make a correct, logical decision.
Welcome to Get Invested on the Property Hub podcast channel, the leading weekly show for Australians who want to learn how to unlock their full self, health and wealth potential. I'm your host, Bushy Martin, and each week I go deep with the best investors, experts, leaders and founders to find out what it takes to break free from the grind, discover freedom and to live by design. Subscribe now and join me and get invested in the life that you really want. Let's get started.
Hi, creative fighters. Let me start with a few very simple but quite powerful questions. Have you ever made an investment decision that looked right on paper, but just didn't feel right? Are you relying too heavily on spreadsheets, data points, and expert forecasts while ignoring deeper, less tangible signals that actually shape long-term success? And here's the kicker. Could your own unconscious biases be silently sabotaging your investment potential without you even realizing it? Well, today, we're going to shine a light on what most investors overlook. And it starts with someone who's walked the long road from short-term wins to sustainable wealth for himself, his clients, and his community. Now, I want you to picture something. Imagine you're standing in front of two properties. One's in a booming suburb ticking all the boxes with strong median growth, low vacancy rates, should I say, and a glossy brochure in hand. The other, well, the current data says avoid, but something about it just feels different. Not the numbers, but the people, the energy, the green shoots of change, the signs of gentrification, upcoming infrastructure, and the future vision. You can just feel the vibe. So here's the million-dollar question. Which one do you back? Well, the real answer? It depends on how you think and whether you're investing with a transactional mindset or a founder's mindset. And that's what today's conversation is going to be all about. Learning to see through the noise and focus on what actually creates sustainable value over the long haul. Because smart investing isn't just about return on investment, it's about return on insight. And nobody understands this better than today's guest, Lawrence Lam. Now, I could give you the standard bio that Lawrence is the founder and managing director of Lumenary, a values-driven investment firm backing founder-led businesses with long-term potential. That he's managed over $1 billion in investment portfolios, or that he's the author of The Founder Effect, a book quickly becoming required reading for serious investors that we're going to unpack next week. But that's not where Lawrence's story really begins. Before Lumenary, before the polish and the pedigree, Lawrence was like many of us, chasing metrics, beating benchmarks and measuring success by standard yardsticks, until something shifted. Well, today, you'll hear how Lawrence's upbringing, lived experience, and moments of honest reflection have helped him to tune out the noise and tune into what really matters: people, purpose, and principle. In this first of two episodes, you'll enjoy an intimate look into Lawrence's early life, how his values were shaped by family culture and courage, how he rose through the ranks of high finance, and why he walked away from the conventional to forge a new path as an intentional investor. You'll also hear powerful reflections on how our judgment is constantly influenced by invisible bias, why qualitative data often tells a more accurate story than the numbers, and what it means to lead your investment journey like a founder, not just a follower. Today, we'll unpack how Lawrence's life experience informs the way he now invests, and how you can apply the same thinking to your property decisions by backing character over charts and vision over volatility. And if you enjoy what you hear today and you're wondering how to apply this to your own unique investment path, then book in with me now for a personal solution session via the link in the show notes. Next week, we'll go even deeper, exploring the ideas in Lawrence's brilliant book, The Founder Effect. We'll unpack the practical frameworks that you can invest with more clarity and conviction. But first, it's time to meet the man behind the mindset. So if you're ready to stop following the crowd and start leading your wealth journey with clear-eyed vision, You're going to love this revealing, insightful chat. So welcome and let's get invested, Lawrence.
Hi, Bushy. Great to be here with you.
Absolutely. Yeah, looking forward to this chat. I guess I'd like to really start at the beginning with your story and your approach and your journey so far. So can you sort of start by sharing with us your sort of favourite funny story that you or others tell about you think best sums up who you are and what you're about?
It's a good question. Funny story, probably more from my wife than me. The one that she tells at dinners with friends. It's usually we take an annual trip. We go to Bali or somewhere sunny, and we're sitting by the pool. And because I'm writing for the book, I bring along a whole stack of papers. She's like, "What are you reading?" Well, I'm reading interview notes with founders in preparation for this book and the research I'm doing. And that probably sums me up. I think it is a combination of me being really focused on what I like to do and not being able to let go. So that's the one she kind of tells with a bit of a smirk on her face, especially because I have a 1.5-year-old and she'd love me to switch off on occasion.
Yes, I suffer the same disease, Lawrence, so I know exactly what you're talking about. And I guess switching into what you're doing now, can you give us a bit of an indication of what you do differently and, more importantly, why you do what you do, Lawrence?
Yeah, Lumenary is an investment firm that specializes in founder-led companies, investing in companies or equities globally. So those two things in itself are already quite different. Founder-led companies and global already quite different. But in terms of investment process, I start with a heavy weighting towards people and looking at the motivations and the alignment of people, as well as the numbers. Can never ignore the numbers, but that forms a big part of our investment thesis and also the skin in the game aspect of what we look for. Yeah, and I think these days, with numbers being so readily available to investors, it's very easy just to focus on the numbers. Arguably, the harder part is focusing on that qualitative side. And you mentioned in your introduction, looking at two houses in different suburbs. The numbers are historical. They are things that have happened in the past, right? And as an investor, though, what you should be focused on is the future, the potential, because that's what gives you the returns. It's not what's happened in the past. And so a big part of my thinking is that, numbers are good for historical context, but people and their motivations is what drives decisions. Decisions is what drives companies and what they expand into, how they grow. And that ultimately drives returns back to investors.
Yeah, 100% agree. And it's interesting with what's happening in property in recent times, Lawrence. It's much more approaching the sort of perfect market analysis that applies to equities these days because there's so much data available that there's opportunities for market moving and everything now occurring in property that never was in the past. But the trap is that there's so much reliance now on the historic data because it's so readily available that people confuse themselves because they bury themselves in it and can't sort of sift the gold from the dross. But also it means those future indicators, things that are really going to move the needle in terms of what an area is going to be like in 10 to 15 years' time, get shunted to the bottom of the pile. So I think there's a lot of similarities there, which I'm sure we'll unpack in our discussion today. But I guess sort of kick things off, Lawrence, I'd love to sort of rewind a little bit if we can and get you to share what sort of moments or mentors have actually shaped your core values and beliefs and your approach to investing as it's developed and why.
Yeah, well, I've had a varied career. I actually started out in financial regulation, working for APRA. And this was sort of pre-GFC, so very calm days, almost a bit boring, which is why I kind of eventually left APRA to join Deloitte. But they often say that, if your first job teaches you or grounds you in a certain mindset that you hold on to. And for me, that experience at APRA was very much focused on risk management and looking at companies with the lens of, okay, what could go wrong and what are you doing to mitigate against those risks? And as I mentioned, pre-GFC, so things were going very smoothly. And it would eventually be shown that APRA was actually doing a fantastic job, because they're kind of like a goalkeeper where they only show up in the news if they've done a bad job. But if they do a good job, that you don't hear about them. And we, often don't hear about APRA and the fantastic job they've done to overcome, COVID and GFC, with much of our financial services sector intact. And I moved on to Deloitte after my role at APRA, where I focused on derivatives and consulting. There I saw a wide range of different companies: private, public, listed, non-listed, small, big. And I came across a company that really stood out to me. It was a winemaker out in regional New South Wales. They stood out to me because they were running their business in such a different way compared to all the other companies I'd seen. They had very little debt. They were expanding during the GFC when others were contracting. And they were actually buying out businesses when others were kind of cutting spend. Yeah. And yet at the same time, the numbers showed that they were consistently performing and producing very high margins. I found out later that it was a privately owned family business. And that sort of was the first moment in my career where I saw something quite different. I saw that here's another way of doing business that isn't, just blindly following the herd. And yet this company had been around for decades. I think they were up to their third generation of family members running the business. After Deloitte, I moved on to Royal Bank of Scotland and MUFG in investment banking. And that was an interesting experience because, sure, you get all the training and the groundwork in the quantitative sense, looking at financial structures, tax, looking at advising clients on big transactions, big deals. But actually, the most interesting thing that came out of that was two things. One is my mentor said to me, tell me the story behind the numbers, not just what the numbers say, but what actions, decisions, behaviors are driving those numbers, because that's more important for predicting what can happen in the future. The second thing that was most interesting was the behavioral side. There's an annual bonus season in investment banking, and you can start to see, as bonus season comes around, the meetings that happen, people lobbying for their own teams to get bigger slice of bonuses, and the behaviors totally change, and the goalposts and the KPIs start moving. It was interesting because that experience taught me a lot about human motivation. And investment banking, you make a good living, good money, but it's very short term. It's very transactional, and it's year to year. Yep. And I contrast that to my earlier experience looking at that winemaker in New South Wales, and just the different style of business. An investment bank makes money cyclically, but this winemaker made money consistently over 10, 20, 30 years. And so that those experiences have shaped how I see investments, how I see the world, and in particular, kind of the psychology behind business.
Yeah, it's a good. I love the fact that you've sort of experienced both ends, because I, personally, a big believer in the old Simon Sinek's infinite game approach to the whole exercise. Because as soon as you restrict yourself with very short term dates and numbers, then everything starts to respond to that. Whereas if you're taking an intergenerational approach, like you've described with the company you talked about earlier, then everything changes. And it means that you're looking at trends and directions rather than very short-term finite results. And it means that the ethos behind the whole culture of the organisation then becomes completely different in terms of how you're responding and acting in the immediate term, because it's what's your long-term vision is really shaping what you're doing day to day rather than what's going to happen next month or the next quarter. How does that transcribe then into what you're doing with Lumenary as a result of all that?
Yeah, so I take a very long-term view on investment horizons, and so too do my clients. And a big part of the investment process, it built into that, is an analysis of management teams and founder-led companies. So there's two funds in the business. One fund is a concentrated founder-led only fund that focuses on global companies that are listed and where the founders are intimately involved in the company, either through board, management, and or through shareholder ownership. The second fund is a much broader, diversified fund, and that focuses on companies that are, that fund is more US centric, whereas the first fund is more focused on Europe and Asia. So in terms of my experience and how it's flowed through to Lumenary, it's a big part of the investment process. And when those things change or fall apart in terms of motivation, that's where it informs how we think about potentially divesting from companies. And that's one of the lessons I've learned in my 8 years running the fund is you have to keep on top and stay on top of what's happening with companies, with people, because ultimately motivations and alignment can diverge over time. So you need to keep your finger on the pulse.
Yeah, a couple of questions that I guess fall out of that, Lawrence, for me are, given, I think I've heard you talk before, there's about 40,000 different companies that you can consider across the globe. What percentage of those do you think are truly founder-led in the context of what we're talking? That's probably the first question. And I guess the second is getting access to information that's really going to inform those investment decisions, given that not much of that's written down, must be a challenge. So I'd love for you to share a little bit of that with us as well.
Yeah, there's about 40,000 or so stocks in investable markets around the world listed, and the universe that I play in, the founder-led company, there's probably about 1,000 plus or so, and up to obviously with a minimum size. There's every company starts off as founder-led, but one of the keys to success in founder-led investing is determining which ones of those will stay founder-led. What type of a founder do you have? Is it like a flipper type of founder, short-term, hype up the company, sell it off?
Yep.
We've seen a few of those here in Australia, and the quirky thing is founders often have a knack for knowing when their company's overvalued, and then they exit. So you've got to keep on top of that. Or whether you have the type of founder that is truly, truly long-term minded and thinking, okay, my name is on the logo, my surname is on the company name, and I'm thinking about growing this business for my next generation and beyond. So they're very distinct types of founders. And the information that's often, luckily in listed markets, there's things called significant shareholder reporting, where you can actually find out, who are the main shareholders in a company. If I draw a parallel to the property, a lot of the contracts of sale, you could probably find who the vendors are, and you can sort of deduce what their motivations for selling are as an investor. So that's probably the parallel I would draw. Like a lot of people just look at, what's the price of what's the yield? But I'd encourage you to think about, what situation is the vendor in? Are they distressed? Are they looking to sell because they're, feeling financial pinch? In which case it's a good opportunity to try and pick a company up at a good price, a property, I should say.
Yeah, no, absolutely right. And it goes right across the board too, picking up selling agents who are lazy and are just wanting to tick and flick, and who are a bit desperate because they haven't sold much for very long. They're much choicer picks to negotiate hard than others. So it all comes down to that personality, cultural piece that a lot of people ignore because it's very difficult to put a measuring stick against. But if you're attuned to it, then that can be the difference that separates you from the pack that might be all revolving around the short-term historic numbers. Let's now sort of, I think, jump into your own personal investment journey that sort of led you to Lumenary, if we can. And I'd love you to talk us through some of the nitty-gritty in terms of what did you do, when and why, what challenges have you overcome, what's worked and what hasn't, and what have been some of the key lessons from your investment journey. And just to throw some extra complication to that, where, if any, does property fit into your personal equation and your thoughts on it, if you can?
Yeah, I think so the evolution of how I have invested, I've always been investing personally. And one of the earliest influences I read about was actually not not a personal mentor of mine, but you can actually learn a lot from books. So Benjamin Graham, who's Warren Buffett's mentor, talked about in his book, Intelligent Investor, actually, before you even get into investing, he talked about getting yourself set up with a strong financial foundation. And one of those things he mentions is getting yourself set up with shelter property before you even start thinking about investing more in a broader sense. Now, for most people in this environment, Benjamin Graham wrote the book in the 1900s, so mid-century. So it was a different time, but it's almost impossible to buy a house first these days before you start thinking about investing. You almost need to think about it in parallel. So for me, my journey was I looked at getting a house first. Vicariously through that, I started thinking about, okay, I now need to think about a long-term plan on not just getting a house, but setting up an investment portfolio that is well balanced and diversified. Yeah. And a big part of that is equities for me, because if you think about it, any one person, you have your PPR, your principal place of residence. Yeah. That already represents half, if not more, of your personal investment. Yeah. And so if you go deeper into property, then you're kind of missing out on being able to diversify with other types of investments like equities, like fixed income, for example. That's what led me to invest in equities, because once I had that set up with my first property, then I was looking for other asset classes. Some of the key lessons that I've learned is, and I've been burnt myself and have scars to show for it. It's the really being very diversified, and because as confident as we all can be, no one can really know it all, and no one can really predict what will happen in the future. So if you go all in on one thing, it's a very risky strategy that can actually set you back potentially decades if you make the wrong call. And it's not that you're a bad investor. It's just that you can't know everything about an investment. What you can do is mitigate risks to a point where it's you have high confidence, but you can never be 100% confident. So diversification is key to overcoming that potential black swan event that we just don't know about. Yeah. The other thing that I think is important is the discipline of knowing when to sell. And this has occurred to me both in my personal experience and also through Lumenary. So, I've started businesses in the past. We've started a law firm. I've also run a funds management business. So I've experienced with both big corporations, working within big places, and also being an entrepreneur and a founder. Part of that is in one example, we bought a commercial property, and it was yielding a very high return. But actually, when I looked deeper into it, and when we owned it for a few years, the capital growth wasn't there, and that was because a lot of new builds were happening nearby, and prices were coming down. So the key there is knowing when to sell, and we've seen a lot of investors hang on to investments hoping that they will eventually come back up. But if you look objectively at things and you kind of take away the cognitive bias of the sunk cost fallacy, you sort of take a step back and you think, well, actually, my capital, there's an opportunity cost in holding my capital in one asset class when I could have shifted to something else. Yep. So that's when you need to have that discipline to know when to sell, when to cut your losses and move on. And as I think it's Charlie Munger or Warren Buffett said, if you lose money, you don't need to make it back in the same way. You can make it back in another way. So take away those lessons and move on to something else. And yeah, I would say those are the key lessons for me in my personal journey is get a house first, establish yourself, then think about diversifying your portfolio and having the discipline to know when you make a mistake, which all investors will at some point. So knowing when to move on and cut your losses.
I love it. And I love the fact that you're embracing. I call myself a blend investor, really, Lawrence, because I've got foot in both camps, and I went heavy on equities early on. Then when I went through the really strong growth phase, I was more orientated toward property, and then coming out the other end where I'm now looking for cash flow as a more important exercise. I've sort of leaned back into the equities front. So I don't think it's static either. I think you need to evolve your approach over time depending on what your goals are and where you're heading, what your capacity is, obviously. But having that diversification, and I think you make a really good point. It's let's have a look at the opportunity cost. Don't be stuck with a dog just because you've spent money on it and you're scared about how much it's going to cost you to sell and get into something else. Diversify either into another area in another property or into other investment vehicles that are going to give you that spread and not be so reliant on one particular market event that could potentially put a big hole in your future plan. So love your sharings on that. I want to sort of revert back now to your sort of founder-focused approach, if we can. And given your focus on the founder as well as the figures, how do you think that's relevant for property investors to put it in that context?
Yeah, I think that you often have to look at the people behind the deal, and you mentioned their motivations with real estate agents, for example, that are. I think that in property, actually, there's much more. You talk about efficient markets in equities. In property, there's probably more room for inefficiency, depending on the deal, depending on the vendor's personal situation at the time, how desperate they are to sell. So I certainly think that there's more inefficiency in property markets that investors can capitalize on. In writing the book, I interviewed a lot of founders, and the thing that struck me the most is an ownership mindset. They all have this mindset of owning what I'm doing, and thinking and that leads you to do things that think very long term, and very conservative way of managing and looking at business. So for property, it's the similar mindset. I think that property, you can certainly look at ways of adding value, looking at tenants and thinking about, hey, should I increase rents or should I think longer term and maybe keep the tenant happy and keep it occupied, and maybe I won't increase, and taking a longer term view of that. And then looking at property as part of your broader portfolio and thinking deeper about more the qualitative side of things, such as the location of the property, and then potential upcoming risks. Yeah. So I bought one of my houses in 2014, and back then so near North Melbourne. So it's a small suburb called West Melbourne, which is quite close to the CBD in Melbourne. Yep. But at the time, I remember a builder saying to me, "Why would you buy in that area? There's nothing there but warehouses." That's what he said to me. And if you took the short-term view, and he was probably right. It's a very industrial area. But I've lived here for over 10 years now, and I've watched the whole area change. And all these warehouses have now been converted into apartments. And there's just a flow of people with Melbourne Metro coming online, with new train stations coming in. The area has totally changed. And that demographic shift has made the house prices go up. So that's just an example of, if you look short term, you probably won't see opportunities, and you'll probably have the same mentality as the herd of people that are thinking the same way. But if you do look a bit longer term, looking at sort of the qualitative side, you might find some interesting opportunities.
100% agree. That's music to my ears, Lawrence, because I often say when you're buying a property, whether it's for investment or only use, it's still an investment because it's going to be part of your portfolio long term. You need to be thinking about what's going to change in there, and not what's there now, what's happened, what's going to change here, what new infrastructure, what new industry diversity, what gentrification is going to change the culture and the feel of this place, and think about who you're going to sell that property to. Don't think about buying it so much, but who's going to buy it in 15, 20 years' time. If you go in with that sort of long-term approach, just like you do on the equities front with that founder focus, then the decisions you make are completely different to the ones you're looking at if you're just purely looking at the here and now. So I'd love for you to perhaps share a moment in your investment journey when trusting qualitative insight, in addition to the numbers, has actually led to a breakthrough investment for you, if you could.
Yeah, a big part. So I can give you some examples during COVID when a lot of companies, their share prices fell by 40, 50%. And there was one particular company called CTS Eventum. It's a German-based company listed in Germany with a founder that's been running the company for 20 plus years. The company is basically like a Ticketek of Europe, and they have a near monopoly through Europe. So they run live events, they sell tickets, they have a strong distribution network. Their share price fell 40% during COVID. And as you can imagine, when the whole world was shut down, investors were thinking, well, their revenues are just going to fall to zero, which they effectively did. They fell to zero. So a lot of people panicked and sold out of it. But based on an investment framework that I use, I don't just look at the numbers. I look at the qualitative side and the potential. And I saw that this company has a monopoly. The fact that the industry is shut is not company specific to them. It's a broader macro risk that will have affected all of these companies in the event space.
Yeah.
And so when I dug in and looked at so the question for me wasn't so much do they have a strong market power and strong ability to attract customers? The question was more, can they survive this interim period? Because for me, I did not believe that the world would end and we would have no more events forevermore. That was not the case. It was surely the case that events would come back. And as we've seen, they've come back much stronger.
Yeah.
And so if you just look at the pure numbers, you would have been scared and you would have been one of those people that sold the share. For me, it wasn't so much about blind hope, but it was more about looking at things like customers and the suppliers of the company. Do they have government support? And they did. Do they have a competitive edge? What's their market position, which they were the European leader? Is the founder still involved? All those things pointed to the fact that the fundamental company was still very strong if they could survive this 1 or 2 years. And they did through government support in the end. And that's been one of the best investments that we've had in the fund because they've more than doubled since COVID.
Great example. I love that. Let's sort of jump into the future a bit now, and I'd love for you to share your personal definition of what you consider to be sustainable investment success and how you're achieving it and how others can as well.
Yeah, I think sustainable has to be repeatable, and it has to be, because it's repeatable, it has to attach itself not just to a once-off lucky shot. And in order to do that, you need to develop a way of thinking, an investment process, a framework, one for sort of the whole spectrum. So you start with sourcing your investments. Where do your ideas come from? How do you look for the opportunities? Right through to how do you make an investment decision? If the decision isn't working out, on what basis do you exit that investment? As we've spoken about, and then thinking about, okay, how do I then use that capital to start that process again and look for more opportunities and repeat that again. So for me, sustainable means rinse and repeat. It means a framework. And then it lends itself to thinking a bit longer term, a bit broader within your overall portfolio, and continually minimizing risk. So we've seen that, say, stock prices, they can run up to huge bubbles.
Yep.
If you just stay with that bubble, you might, even though you make a gain, you might lose a fair bit through volatility. But how can you have a process that if there is a bubble and you can see there's a bubble, you can continually reallocate your capital? It might be that you might move into another asset class like property.
Yep.
You take money off the table, you move into property, and then eventually stock markets, go up and down, and the bubble bursts, but your money's kept safe in property. And that's when you come back into property, into equities. So that to me is sustainable investing, because there's a clear strategy and a framework that runs through the whole market cycle.
Yeah, I love that. It sort of echoes to me very much the sort of Warren Buffett style exercise where he's quite happy. I think a big mistake that a lot of people make, and not just in equities but property as well, by the way, is the feel the need to have to do something. Now, that urgency can often create decision making, investing in things that aren't right. So you're better off to do nothing. And like what Buffett sits in cash for a long time, and then he only swings that baseball bat very occasionally. But when he does, he often hits a home run. So I think part of it is having the ability to be comfortable doing nothing if the conditions aren't right and the opportunity's not there, and wait and keep a very close eye on when the opportunities do arise, and then jump in big and hard. Does that sort of relate to what you're thinking?
Yeah, absolutely. And I'm a big reader of Ray Dalio's books as well.
Yeah.
And how do you know when? I think the next question that a lot of investors will have is, how do you know when something is good value or when it's overvalued? How do you know if we're in a bubble or not? And a big part of that comes from having context through history. So I would encourage a lot of investors to study what's happened in the past, in the 70s during the inflation spike we had there. Yeah, right through, and going back even further, and then you start seeing these trends, and you start getting context over what is relatively expensive, what is relatively cheap, and you'll know what situation we're in the current era. So that context is, and being a student of history is very important in investing.
Totally agree. Sort of circling back now then, Lawrence, if you could go back and give yourself or your younger self just one piece of investment advice, what would it be?
I would say never waste a good correction. And what I mean by that is, if you see that there's a downturn or a correction or a crash, you know that there are going to be bargains on the table, and do your preparation beforehand. So have all your targets in mind of what you're going to invest in. And if there's a downturn, and I would argue right now in the stock market for sure, we are heading into correction territory.
Yeah.
I would say in property that there are some areas where I am seeing that vendor expectations have come down.
Yep.
We are entering into a period where, hey, it's a good time to not waste this correction.
Yeah, I love that. And in fact, in concert with that, I've actually been saying that I love times like we're currently in. At the time of recording, we're seeing the tantrums sort of play havoc with the markets. That is the best time. I love those periods of uncertainty because the fear that it gets amplified through the media causes a lot of people to take the losses and take the hits, when you and I both know that every time there's a major shock of whatever, yes, there's a temporary dip, but particularly for property, because there is that safe haven exercise that sort of it captures and take advantage of. These are great times to be securing good quality assets. All the fundamentals have got to be right. Don't get me wrong; it's got to tick all the boxes. But being the contrarian that I think good investors are, times like these produce some great opportunities for those who have the courage and the fortitude to swim against the tide and stick with what the numbers and the intangibles are really telling them to take advantage of. So I love that. Let's have a bit of fun now, Lawrence, and I'm going to give you the old blindfold and cigarette and jump into what I affectionately refer to as the ambush or bushfire lightning round, wrapping off my old nickname. So I'd love your short, sharp and fairly straight from the heart thoughts on these following questions if I can. And the first of those is, if you could have a coffee with anyone, either living or dead, who would you choose and why?
Charlie Munger, just because of his brutal honesty. And you're going to get the truth from him. And I'd be really curious to get his thoughts on my book about founder psychology, because they talk about owner-operator mindset. So it'd be really interesting to bounce my ideas off of his views and his experience.
Yeah, I'd tell you, he's a great loss to the world. And I bet you Warren Buffett is without having that sort of bouncing board and that sort of foundation of truth, because Charlie's pretty good at calling it exactly how it is and explaining things in a language that everyone can understand, which is quite refreshing in the investment world at times. Love that. Back in the investment arena then, what's both the worst and the best piece of investment advice that you've ever received, and why?
The worst is any sentence that starts with never do this or always do this. That's the worst thing you could do. I would not accept that from anyone mentioning that to you, because in investments, it's always a case-by-case basis and it's always independent thought, and no rules hold true. We have seen what we thought was the end of the tariff era come back in. So anyone that thought that was never going to happen again was wrong. So that's just a classic example of why that's the worst piece of advice. The best piece of advice is to separate what is noise from what is fundamental. So if you're looking at opportunities, they might come from someone at a barbecue mentioning something to you, but they'll often outline why it's all the pros and cons. But you need to separate with independent thinking what is just noise and what is actually fact and true, and with merit. So I would say that separate the noise from fundamentals.
Yeah, love that. Completely different subject, and you're going to put your cape and mask on now, Lawrence. If you could have one superpower, what would it be and why?
Ability to slow down time. Not because I want to do more. It's just about prolonging the present moment. Because I often, speaking just personally, I think moments that are really important to us often go by too quickly, and we forget them. So yeah, if we could slow down that window, it would give us a lot of joy and happiness, I think.
Yeah, well, that's a good one. A very good one. On a different subject altogether, then, just to close this out, I'm a big believer in time leverage and compounding being the builders of wealth in anything and success over time, but they are built on our daily habits and our rewarding rituals that we do repetitively and over and over again. So can you share with us a happy habit or daily discipline that you think's contributed most to your success today?
Yeah, I think investing you have to think very broadly. And for me, that means also looking outside of investing and thinking about mental and physical health. So one of the things that you talk about compounding, I really enjoy playing basketball. I think it's great for my mental health. The injuries, not so great for my physical health, but from a mental point of view, seeing a regular bunch of 20 guys on a weekend, talking a bit of smack sometimes, having a bit of fun is a fantastic way to get a broader picture of and perspective with life. And not everything's about investing. We invest because we want to live a good lifestyle, and to achieve that, what's the end goal you're looking for with your investment? So that mental side helps you think about that more broadly. And then just for physical, I think it helps my thinking when I'm moving well. So mobility, flexibility, cardio, strength, those are all things that I focus on outside of investing. And I find that, just the more polar opposites you have, the more perspective and the more context you have, and yeah, a more fulfilling life you have.
Love it. I'm a lot older than you are, Lawrence, but I'm still making use of myself on the hockey pitch. I've not been a mad field hockey player since I was 11 years old. So I've been giving way, mate, but I've been playing for over 50 years now. And yes, I'm a lot older than everyone else, and I'm a lot slower now because it's the old cunning that gets me around. But for exactly the reasons you've mentioned, that camaraderie, being physical. You have to live in the moment when you're playing a sport. You get to learn a lot about people when you're playing sport as well. You get to see the true person behind the mask often when you're out on the pitch with someone. I think that the benefits of all that, it doesn't matter how old you are, how good you are, if you keep doing it, then that broadens out and gives you a much more holistic view of what the world's all about. So love that. Final question then for today's episode before we think about next week's. What's the one question that you wish I'd ask you that I haven't? How would you have answered?
What's an investment belief that you have that no one else does? And I would say not that no one else does, but I think that a lot of people overlook. And that is, great investing is more about the temperament of someone rather than the knowledge, IQ, or tactics, strategies. They're important too, but above all of that is probably temperament, because the real edge lies in how you behave, especially under pressure. And when a classic example is that you get we spoke about earlier with a property that you're thinking about selling, and you can see that capital growth isn't great. That's more of a temperament question, because that's more about, can you overcome some cognitive biases within yourself to make a correct, logical decision. And with the stock market, it's the same thing. When everyone else is panicking, do you have the temperament to remain calm, look long-term and think, actually, this correction is a good opportunity to actually invest more? So those are the things that I think matter the most with investing, that many people overlook because they gravitate towards whether it be short-term profits or short-term strategies and tactics. It's all good when things are going up, but investing has to be sustainable, right? So you have to be able to make money going up and also when things aren't great.
Yeah, I love that. The temperament's a great way to sum that up. And again, it's one of those intangibles that very few investors really even aware of, yet alone focus on. So I really appreciate you bringing that to our attention, mate. So look, I really want to, I know that we could talk forever, and we'll continue the conversation, particularly digging into cognitive biases in next week's exercise. But I just want to thank you for taking the time to share your own personal growth story and investment story so far. But before we go, if anyone listening would like to keep the conversation going in a very safe and open forum where you can take your property knowledge to the next level by sharing and learning with other like-minded property investors and property professionals to get all of your property questions answered, join Eddie the Frenchman, myself, and a host of others now on the Property Hub Collective Facebook page by clicking the link in the show notes. We now look forward to continuing our conversation with Lawrence in next week's episode, where we're going to unpack his unique insights from the detail as we book the founder effect. So hit the subscribe and like buttons and share the episode with your friends if this has been useful. And remember to always get invested in your knowledge and your network before you invest in assets. And we look forward to getting invested with you again then. Thanks, Lawrence.
Thanks, Bushy.
Thanks for tuning in to Get Invested on the Property Hub podcast channel, your home for property investment insights and inspiration. Make sure you subscribe to Property Hub for free. Get your weekly dose of Get Invested inspiration along with every episode of Realty Talk, Australia's top online property show for red-hot property investing news and insights direct from industry leaders and influencers. And finally, I'll see you next time.